Thank you for joining us for our Seaspray Making Waves podcast series, brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast.
Hello again, and welcome back for episode 4 of the Seaspray Making Waves podcast series. The series is available on the usual platforms, YouTube, Spotify, and Apple, and on our website. We would encourage you to log on and follow us on LinkedIn, and to subscribe for free on our website to our suite of research. And I'd particularly like to bring to your attention our new weekly market review, which we launched a couple of weeks back. This is available and will be issued every Monday, and is also available to view on the rte.ie business page on their brokers reports section. So that's a new addition which we're very proud of. So it's just been a couple of months, short months, since we had our last chat. A lot has happened since then. A lot of the same factors that affect the markets are still lingering, in fact, dominate the conversation. Inflationary environment, tight monetary policy, and obviously in recent days we've had the political unrest in the Middle East and the escalation to what is almost an all-out war between Israel and Hamas, and we'll address that in the conversation. And in recent days, hot off the press, we have the national budget announced by Ministers McGowan and Donoghue, which seems to be a case of political opportunism trumping fiscal prudence, and we'll discuss that in more detail as we go on. I'm delighted to say that joining us today to sift through some of the key events and to look forward somewhat are our usual Seaspray contributors. We have Paul McGowan, Seaspray Financial. Thank you, Paul. And Danny, head of Seaspray Private. Morning. Good to see you again, guys.
Good to see you.
Great. To kick off, I believe, Danny, you've got a little bit of breaking late news for us, and it's nothing to do with Ryan Tubridy, but maybe a little bit of nostalgia, I think, is it?
It's. I was just looking even this morning on the radio coming up as we're coming up. I go back to the days of Airtel, if anyone is still with me in terms of that. 40 years ago, it came to life on the RT, on our television screens before any apps, before the internet, before anything with Google or any of that nature. And it was one of the best information services of its time. And it was from RTE, and it was there. I remember page 200 in the sport, and people will have their own favorite pages in terms of that. But I remember CAO points were there. I remember travel flights. You could get any information on Airtel at the time. And my last look at Airtel, believe it or not, was during the pandemic. They also had information while the pandemic was on. So it was still there and being used at that time. But as at this morning, Marty, a bit of nostalgia creeping in, no more Airtel. And, I have to say, with a little bit of disappointment, because it was great. For me, the sports.
Absolutely.
And I know other people would have had different scenarios that they would look at. And I'm probably talking to a generation that may remember it, but there's a lot probably out there now that would be saying, what's he talking about? Airtel, the pace of technology.
Well, that's it. I mean, that has relevance for us. I think it's just the way we consume our information these days, how far we've come, and the influences of artificial intelligence and all of that, which we will touch on, I'm sure. But it's a sad day for that. So
I think it just shows how far technology has come, but there's a massive sort of leap as well coming down the track with generative AI.
Definitely. So you brought us back in time there a little bit. So, but I'm going to bring us back, not quite as far, bring us back about 9 months when we had our inaugural podcast, and we published our 2023 outlook. It's fair to say that I think a lot of what we discussed then still holds today. And what I'd like to ask you is in your view, the Seaspray scorecard, how have we done in terms of our key calls or macroeconomic and market-related calls in that time?
It's good to reflect. I think the one thing about forecast, Paul, is that we'll always get it wrong.
Yeah.
There's all parts that won't happen. But I I have to say that a large part of what we were saying at the start of the year has been playing out. We may have got the timing a little bit wrong. Equity markets are up around about 10, 12% year to date. So from the lows of where we were, there was a sort of a bull run up to the peak in July, Marty. And the last couple of months, we've seen that pull back, and we can go through that. But in general, we said risk on during 2023, and I think that has played out so far during the year on that one. On the geopolitical side, our thoughts were with Ukraine at that stage. And I think we've witnessed in the last few days, our hearts go out in terms of the people and the suffering in terms of Israel and Hamas. And that will influence and add to uncertainty. But it's more about thinking of the people and the heartaches that are going out there at the moment. So geopolitical is still with us. And we said it was going to be still with us for the next 18 months. And now the added sort of situation from the Middle East, it certainly doesn't help. But again, I'm probably of the view it will be contained, fingers crossed. But our view would be that it's certainly not a help as we go into the fourth quarter in terms of that. I think in terms of the main talking points would have been the central banks and monetary policy. Their focus, we said at the very start of the year, price stability. They want to get inflation down to 2%. And boy, have they been very much focused in doing that. And I think that's coming out to play. So I think we called that, but I think the key that we probably missed out a little bit was interest rates with us higher for longer. And I think we'll highlight a little bit of that as we go through. Sure. The currency side of things, I think we highlighted the dollar strength this area. We thought it might weaken a little bit as the year went on because we thought interest rates might peak earlier. It's later. And I think the dollar strength is going to continue for the next while. So in the main, in terms of looking at the key headlines, I think there's a lot in it that I think that still holds up. And I think we're going to be moving into 2024 with a few more scenarios in terms of uncertainty on the geopolitical side. And I think interest rates higher for longer is probably the key coming through in terms of as we go into quarter four.
Yeah. I think it's difficult to have a crystal ball, and events like this week are obviously going to come in and rock the market. Absolutely. To an extent. But you feel that looking long term. And having that long-term view is critically important, and to look beyond, because history will show that events like this have happened before.
If I take you back, and again, I remember in the '67, showing the grey hairs, but the 7-Day War. There's been the Middle East and Israel, and the troubles are there for a long time. You would hope that peace would eventually come about, but it's not there, and it's a really bad time in terms of where we are. But I believe we have to look through that, and over time we have seen many crises, and the markets have looked through that. People have looked through those. Yes, our view would be that there is uncertainty there now. We hope that peace will eventually, or talks will happen. And the same goes for Ukraine and Russia. Wars come, but they do tend to resolve over time, no matter what length of time that may be. And when you look at the market reaction to that, markets look through that. And I'm really saying to anyone out there in terms of their portfolios, we have had a lot this year to deal with. Cost of living. I mean, everybody out there is being hit by high energy costs, electricity. There's a lot of day-to-day stuff that we've got to take on board. But the critical thing is that the actions being taken, I do believe, will bear fruit for us for 2024, 2025, and 2026.
Yeah, absolutely. And from a financial point of view, we obviously have an opinion, but our thoughts are with the people of Ukraine and the Middle East for sure. That's to be acknowledged. Paul, just if we can focus on equity markets specifically, and they're coming off a peak in July. Yeah. What's driving that, and how do you see the markets responding?
The current situation. Okay. Well, I think if we go back to the end of the second quarter, there was, as you're coming through it, markets ran on the anticipation that rates had peaked and that we would see rates coming off in the second half of the year. When the central banks then came out and started saying, no, we're going to have higher for longer. And in fact, we had a situation in quarter three where both the Fed and the ECB increased rates by a quarter point each. Then we're in a situation where that view slightly shifted. However, it now looks like the rates have reached a peak. And most of the feedback coming out is that they were just going to leave them steady where they are. So from here, the question is what's going to happen. As you say, we've had a pullback of about 6% since the peak in July. We've also had a really strong earnings season. Quarter 2 was really strong, and Quarter 3 has just started this week, and numbers are already coming in strong. The things to look at is if corporates have been managing their cost base, tightly, well, then the inflationary impact is actually going to be very positive because they've had a big increase from an inflation in their pricing. And so I think in this quarter, we're going to see quite a lot of companies outperform on an earnings side. That will then affect multiples and the PE ratios. So although the market had, particularly on the US side, it got a little bit ahead of itself, on the European side, PE ratios have actually fallen, are actually now slightly below where the long run average is. So there's opportunities starting to open up in the markets, having had a little bit of a pullback. This quarter is always an interesting quarter because you combine the Quarter 3 earnings, and then you have what is traditional, the Santa rally into Christmas type thing. And one of Danny's favorites here. And it's something that, it just happens, often because fund managers want to make sure that they get the best performance into their year end, and barring some major shock. Now, this is where the geopolitical issue will kick in this quarter. And at the moment, the markets have actually been very sanguine with regard to this particular move. I know we've noted in our research that, when we were writing, there's talk of the Americans moving aircraft carriers into the region. There is some very, very strong warmongering coming through from some right-wing Republicans, but that's been counterbalanced by overnight. Even you hear Joe Biden has come out and made statements with regard to the fact that a response needs to be within the rules of a war. And so this is the balance, because what they don't want to do is destabilize the situation that had been developing. This quarter has a number of things going on in the background that are going to heighten tensions for markets. But against that, there's also this, traditionally, you tend to get a bit of a rally. And investors may well look through the geopolitical, put it to one side and say, okay, how have the corporates done? Price earnings ratios are looking attractive. On a relative basis, there's a bit of upside there. We had a big pullback in real estate. We had a pullback in utilities. We had a pullback in technology. I think if the overall feeling is that inflation is slowly coming down, like, for example, we had the PPI out yesterday from the States. It was only slightly up. Today, CPI will be out this afternoon. That'll be a really important number for the markets, because if that's not showing a strong increase in inflation, I think people start to relax a little bit. And this, we're now at the peak, will feed through. And people then focus on the earnings and will say, okay, where's the value? My feeling is in this quarter, we could see a rally in technology, because you've had a big pullback, and it's one of the easiest sectors to get a push into. So,
and it's been quite dominant, hasn't it, for the last while? Yeah. I think that point you make about looking through conflict, etc., is important for our investor clients to adopt that attitude and that approach.
I think we saw that in the war with the Russian invasion.
We did,
And every time you look back at that type of situation, that will happen. And again, it's natural that will happen with uncertainty. But I think the key in all of this is looking through that. We've got to be looking at the longer term as well. And I think for most investors, that is the key. They will look through this and look through the longer term, I think, Marty.
And I think, Danny, to that point, we as a house are long-term investors.
Correct.
We're not short-term.
For sure.
So we're not looking to play the short-term trades. We're looking at trends in markets long-term. So, a perfect example of this is that although we think equities have a good opportunity into year end, we do think that if we've reached the peak in interest rates, there will be a point next year when yields on bonds will start to come back down again. So we are increasingly positioning our clients into the more into the bond side, short duration bonds in particular. So that's a whole area for us, but it's because we're looking long term, not short term, in our investment process.
So just bringing it back to this little booming country of our own here, we've had our budget this week, just on Thursday, announced. So interesting challenge for the government there to try and balance addressing the cost of living and not stoking inflation too much. But I think there's quite obviously there are a couple of points on the agenda, not least of all the climate agenda seems to have a focus this time around. Yeah, would that be fair? And Paul, how do you feel the government have managed to strike that balance?
Well, I think the first thing is just take a quick step back and look at the economy. Yeah. The SRI there just about last week issued their latest commentary on Ireland. And a couple of things. They said we're seeing a bit of moderating growth. Inflation is a little bit elevated. There's a little bit of an international slowdown, but overall, the modified domestic demand is about plus 1.8%, which is very strong. Now, when you combine multinationals, our GDP is down 1.6% for the first time that we've seen in a couple of years. But that's driven by one particular factor, which is the exports is down. And the exports, when you dig into it, it's primarily on the pharmaceutical side, where there's been a big fall off in exports into the States on the back of the demand for COVID. So there's actually a normalization happening just there in the economy at the moment. But overall, tax receipts are still really above what had been expected a year or 2 years ago. And it's against that backdrop that the government have been able to set this budget. And so you have this unbelievable budget where we have 14 billion in total has been the giveaways, with a kind of a 5.3 billion increase in core spending. You have 1.3 billion in tax cuts, and then you have another 2.7 billion one-off kind of payments that they're doing. This is an unprecedented budget payout. It is good for everybody. It doesn't matter what sector, what you're in, it's good for you. You've got personal allowances. So on the income tax side, you have personal allowances are all up. You've had a widening of the higher tax band, which means that it's taking some, a larger portion of people out of that top tax rate. You've had a reduction in the USC, which benefits the higher employed people as well. You have a situation where there are increased allowances across the board for single parents, for support to families. Then on the welfare side, there's been increase in almost every welfare payment. And there's substantial increases, despite what people might say, like £12 a week on the pension. All of these are large increases, which will be maintained. Then they worked on there's issues about housing, so they've increased the rental allowance. And then on the other side, they've given a special allowance for landlords because they want to keep the smaller landlords in the business. They're trying to encourage landlords to stay in the industry. There's also been special deals done for the SMEs to try and help them where there's been, because of inflation and rates increases and water increases, etc., to try and balance some of those out. And then there is the one-off, the special focus, so 3 billion to climate change sort of initiatives, and obviously the start of this, wealth fund, which is really important. And I think what was really interesting in this budget, they've taken a view that they're starting something that won't complete for 10 years, which is the building of this wealth fund. They want to get to 100 billion. And the idea here is that we'll never have to suffer the sort of sudden jerks. If we have another financial crisis, we'll have a major wealth fund that can help smooth out the problems. It's really smart, intelligent management of an economy and shows a government knows what they're doing. The question will be, will they get the opportunity next in 2025 to get back in and continue this process? I definitely think this budget will have gone some ways towards helping the overall view on how the government has performed, because there is a narrative that everything is awful. The reality is, in Ireland, as we've discussed before, our economy has done incredibly well. And being able to have a budget of this size goes to show that,
It is a massive budget. I think the critical thing is that you'll never please everyone. And I think it's a catch-all cost of living budget. I think that's how I would describe it. And you will, as Paul pointed out, there are aspects there that will help people before Christmas, which is very, very important. And I think in the main, it is being targeted at trying to get people through a very difficult time in cost of living. So I think that's one part of it. The other part, which I do like, is this view that whether you're elected or not, there is a long-term view here on climate, very, very important, close to what we're about in terms of climate infrastructure and nature. And the Sovereign Wealth Fund, this is the first for us that can we build a fund of 100 million over the next 10 years? 100 billion to make sure that we can actually manage our way through. And the one key element in terms of that is our aging population. We are going to need funds that can actually support that out over the next 10, 15, 20, 25 years. So I think it's a start. And I do think that while everybody was saying it's not enough or we didn't get this, or I think there's been a balance there, but I do believe it's a very strong focus from a cost of living perspective.
Certainly, but it's the National Pension Reserve on steroids, really. It's really, it's nothing we've seen before.
We need that, absolutely.
And
I have to say, actually, as well as we're talking, Ireland is supporting the French economy as we speak. When I look at the flights over to Paris, when I look at the spend in terms of the French economy, I think the French will be thanking us big time in terms of our hopefully, fingers crossed, that we can continue there to the final. But at the moment, we're propping up the French economy as well.
Maybe we'll be singing Zombie on Sunday.
Absolutely, yes. Yeah. Well, I think the two ministers were waving the green flag for sure. They were, no doubt. But you both mentioned the climate agenda. That has featured quite strongly this year, and I know it will into the future. And some of our recent data insights concentrated on the circular economy as an area to focus on. I know, Danny, you have a lot of experience in this. What are the growth areas in terms of those themes for investors going forward?
I think this is very important. And again, I'm really focusing on the fact that they are very strong themes, but we're looking at the medium to long term in terms of, the dividends coming from this. So from a client perspective, just to put this in context, getting away from fossil fuels and from the oils and everything else, that will reduce greenhouse gas emissions by probably about 55 to 60%. Right. The balance is going to come from what are we doing in production processes today. So the combination of climate and circular economy is a very strong theme that I believe is very important for the planet, but it is also very important that can we capture returns from companies and production processes that are doing the right thing in terms of the economy. So just to give an example, as part of that, the circular economy is anticipated to be at least 4 trillion over the next decade from its current levels. And we are in a situation where we make, we extract, we make, and then we just get rid of stuff into landfills, etc. We've got to get to that stage where it's circular and we are reusing and recycling. And there are strong evidence coming through at the moment that companies that are doing that, doing the right thing, one, are making better profits, and two, they are not dumping into landfills and they're not causing, added problems for the planet. If I just take maybe 2 examples, if we can, Marty. If I take the transport industry, 85% of the parts from cars being made are thrown away in terms of toxic materials, et cetera, et cetera. That could be recycled into new cars in terms of bringing them back and refurbishing and putting them back in terms of the economy. And there's a company out there called Renault, back to France in terms of where we are, but Renault have set up a refactory in Paris, and they are every day 150 new cars from old cars, refurbishing gearboxes, everything, and bringing them out onto the production line from all of those parts that would have previously gone into landfills. And believe it or not, you can buy those cars 30% cheaper than a new one down the road. Now, I think it's that type of philosophy and that type of work that's happening. When you think there are 11 million cars in Europe every year that are going to waste. I just think it's a massive opportunity that we can have companies doing the right thing, and they're seeing that on their profits in terms of profitability, but they're doing the right thing from the planet and making sure that that is happening in terms of the circular economy.
That's a live example of, isn't it, of the circular economy in action there, for sure, you know.
And, you know, there's major industries, manufacturing, there's fashion. Fashion is, you know, another key industry where the waste in terms of materials is absolutely, you know, 85% and more being wasted. And if you take single-use cosmetics, you know, the cosmetic tubes, if they were recyclable, you would reduce global gas emissions by 80%. Wow. And that is the type of philosophies we need to be seeing in terms of companies being at the forefront and people, our own actions. We waste 40% of all that we consume in terms of food. It goes into landfill. For here in Ireland, that's €1,000 for each family in Ireland. Those are the type of situations that if we could compost, if we could be doing things simpler and better and circular, making that circular, and that's where I think the growth theme. So long-winded answer, Marty, but I think they are the actual areas that we believe that we can actually, number one, do the right thing, but number two, get the growth that, you know, from companies that are really at the forefront in that.
Definitely, and I've no doubt when you're out there that sustainability is high on clients' agenda. You know, so yeah, at the moment. Thanks for that, Danny. Some great examples there. Paul, I've just got to come back to yourself on specific stocks for clients that might be looking at some long-term value. Would there be specific ones that you would put on a watch list, for example?
You know, beginning of this year, we picked out a couple of stocks, and to be honest, they've performed really well. But some of them I would continue to put on the list. Right. So we take Ryanair. At the beginning of the year, it was between €8 and €10. Mm-hmm. It's currently €15.86. We've just upgraded our price targeting on it up to €22 from 20. They have, in their September numbers came out, they carried 17.4 million people in September. Year on year, their growth levels are at 9%. Their balance sheet is strengthening. Their orders in with Boeing is ensuring that they're going to have a pipeline of aircraft that are lower cost to them. And when you fly when you go to the airport, their planes are absolutely packed. It doesn't matter what airport in Europe you seem to go to. Their planes are full. So I think you will be. It's the sort of sometimes you get little runs in stocks, and I wouldn't be at all surprised to see if we see the share price gap up in this quarter. Yeah. So that'd be one. And another one we recommended at the beginning of the year was CRH. It was trading just between 38 and €40. Obviously, a lot has happened. It hit €50, which was our year target, and then delisted from the Irish Stock Exchange. It's now listed on the New York Stock Exchange. It's trading at $55 today, and the average US analyst view on it is that this, over the next set of numbers, should come out very strong, and you could see it push on to $70. So it's an Irish team that's now left the market, but I think this is a problem that we're going to have anyway. So following the stocks that we've always liked, that we know well, I would still put that on a buy and a hold list. Smurfit is similar, and it's now going through this merger, which is going to turn it into almost double the size of the business. Again, we've got this issue with them delisting from Ireland, going to be on the States. I still don't see why we don't follow these stocks and we can trade them. And so they would be some of the larger names that I would continue to like. And into the year end, I think, and I don't think you have to chase small stocks. I think this quarter we could get another run on those stocks, you know.
And I think it reinforces, I think the market performance year to date, Marty, has been very concentrated. I call them the Magnificent Seven. You know, when you're looking at Microsoft, Apple's, and Meta, etc., Amazon. So a lot of the performance that we're seeing is coming from that AI, and I know I alluded to that in the last podcast. So critically, the broader market hasn't suddenly shot up. You've got a situation where there is strong value, and I think Paul alluded to the valuations that are there at the moment. I think European stocks are trading at a discount. So when I'm looking at climate, or I'm looking at the ESG, there are valuations out there at the moment that are not expensive. And I think that's the key. So when we're looking at structured solutions, you're looking at a diverse portfolio, but you're looking on the basis that they are not expensive at current levels. And I think that's another key fact. Diversification is a very important
If you look, Danny, at the Eurozone average PE at the moment is about, it's coming in around 11.4 times. Yep. And the long run average for the European markets is about 13.1. So we've got a near 15% discount to the long run, even just for markets to move that much. And you'll only be back at your long run average. So there is definitely upside scope.
Yeah.
And as we described earlier, into a year end, I would be expecting that, bar somebody doing something really stupid on a global geopolitical side.
I think it's very important also. The message of diversification is very, very important. And the critical thing is, last year, stocks, bonds, all suffered. Everyone was, sort of looking at a correlation where, you normally get one that doesn't. It all went down. This year, the market for the interest rate movement has created a different scenario out there in the marketplace. You're now talking at short-term rates of nearly 4 or 5%. Mm-hmm. The market has now, in the last 2 months, the longer-term market has moved out to yields that I'm looking at that weren't 10, 15 years ago. Right. So the critical thing is, you've got a situation where last year there was no money to be made on the bond side. There is money to be made for investors on the bond side now. So you have two asset classes, equities and bonds. So for a typical 60-40 portfolio, you can have investments that are balanced and that can provide returns for clients over the next 2, 3, 4, 5 years. So again, it's managing the risk and it's managing the portfolio and being diversified. I think they're the key messages we have to, to maintain as part, again, that you don't have to speculate and seek the one stock, or that's not how you will make money over the next number of years.
That's sound advice for our clients. Looking ahead, I think that's really, really, really good. And talking about our investors, we as is customary, we have a couple of questions for you, if you don't mind. Easy ones, I hope. I've got one for you, Paul, first. And you touched on this in your examination of the stocks to watch. But with CRH and Flutter having already left, and perhaps Smurfit Capital leaving the Euronext Dublin Exchange, is now a time to be looking at diversifying away from the Irish stock market.
Yeah, well, and a perfect example of this is that Zurich have announced they're closing their Irish equity fund. The problem the Irish market now has is the market cap of the overall exchange is going to drop by multiples. And you're getting your risk of overweighting in Ireland is become very heightened. So we as a house, though, have not had a heavy preponderance towards Irish equities. For a long time, we've really looked at Ireland as a percentage of the overall, and we'd only be allocating small amounts in there. So from our point of view, we're indifferent. We can invest anywhere in the world. We look for value, and that's the key to it. And just drawing back to what Danny was saying there a moment ago, the key to remember as well that the rule of 7, which is if you can achieve 7% growth per annum in a portfolio for 10 years, you'll double your money. With yields now at touching on 5%, if you can buy into asset classes that are giving you that, and then you get a little bit of a pickup on the capital side, you'll be achieving that, and you can lock into that without any historics, without being any heroics going on. So I think the opportunity now is quite attractive for conservative investing, and yet giving you still that nice growth opportunity in markets.
Excellent. Thanks for that, Paul. Danny, I keep bringing you back to the climate agenda. You must be the green man. Climate and green energy stocks have taken a battering this year. Is now an opportune time to invest in equities or ETF based on these themes?
Well, absolutely. I think we've highlighted that valuations have come back. I think on the renewables, just to point out, they've been hit because you've really looked at an energy crisis over the last while, and I think for a lot of the the wind energy type companies, there's one particular company, Ørsted, Danish company, and their share price in August came back 25%. Now, that was on the back, though, of some strategic decisions that they made in America, which certainly has hurt the share price. Right. Yeah. But you have supply chain issues and you have high interest rates. So if I've locked into projects, 12, 18 months ago at a cost of X, and now you're looking at, increased cost, it's naturally hurting in terms of renewables. But I'm very adamant that we are looking at long-term. Renewables are going to be there with us. It won't be the fossil fuels, it'll be the renewables. It'll be wind power, it will be solar, it'll be all of the renewable factors. So yes, they've had a tough time, but I would argue that that's the time that we should be looking at the value in relation to where we are rather than not. So in short, the climate, absolutely. I think at current valuation levels, we are looking at the moment at another climate change. And I think they are the opportune times for the longer term investor to say they're the right time to actually be looking at investing at this particular time.
So a strong yes.
It comes back to the fact that we've a recent stock market and consumer confidence sort of chart. You will see that money can be made when it's bad news. In other words, when the consumer is on the floor, that's probably the time to actually buy. And in that, we're in cost of living, we're in war, we're in lots of difficult situations. Believe it or not, they are the times that we should be looking. It's not when everything is good and rosy. You've got to look at it in there. So just to come back, it is very important that we look through that and we actually say that if you are a medium to long-term investor and you have the time and you have the patience, it's the right time to be looking at that investment.
Key words, time and patience.
Time
definitely,
and patience,
yeah.
right.
So thanks to our clients for sending those questions in. Excellent. So we're going to wrap up, guys. Once again, the half hour has flown, which is no surprise. So thanks again for your input. Some really valuable insight today. That's superb. And no doubt our clients will derive some benefit from it for sure. Cheers. To read more detail on today's discussion, I would encourage you to log on to our website and download our Q3 investment update, which is now available to download, and to subscribe for free to our suite of research, including the weekly market review that I mentioned earlier on. This series of the Seaspray Making Waves podcast is available on the usual platforms, YouTube, Spotify, and Apple, and from the website. I'd encourage you to follow us on LinkedIn. Please continue to share and like our content. We'd be delighted with that and delighted to have you join us. And so thanks again to Paul and Danny, and thanks to you for looking in. And we'll see you the next time. Bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited, trading as Seaspray Mortgages, is regulated by the Central Bank of Ireland. Thank you.